Do you know the 6 key benefits of dividend investing? Well, we're going to cover those in today's episode. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to cover the 6 key benefits. So we're going to start with number 1. Dividend investing generates passive income for you. Number 2, we're going to talk about capital appreciation. Number 3, we will talk about diversification in a dividend portfolio. Number 4, how dividend investing provides you with stability. Number 5, the tax advantages. And number 6, how dividend investing builds your confidence and discipline as an investor. So let's begin with number 1 and take a look at how dividend investing generates passive income for you. Now, a dividend is a cash payment that's paid to shareholders, and it's paid from a company's earnings. So, for example, if a company is paying a dividend of $1 per share and you own 1,000 shares, you are now part owner of the company. You're entitled to share in the profits of that company. And so those profits come to you in the form of dividends. And in this example, if you own 1,000 shares, you'll receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. Now, you can spend those dividends if you want, or you can reinvest them. The dividend is deposited as cash directly into your stock trading account. So now let's take a look at 3 real-life examples and how they will generate passive income for you. So in this example, we're going to look at 3 companies: BCE, CIBC, which is a large Canadian bank, and TC Energy. So on the screen, you can see the annual dividend per share. You can see the current dividend yield for each of those companies. And in this example, let's assume you were to invest $20,000 each in each of those 3 companies. So a $60,000 investment today would generate approximately $3,552 in dividends, which is passive income. So $60,000 invested today would give you $3,552 over the course of the year. Why? Because we can see the dividend yield. BCE has a yield of 5.98% today. CIBC has a yield of 5.9%, and TC Energy is 5.88%. So the $3,500 in passive income, which is coming to you in the form of dividends, is pretty good. Now, what if I was to tell you that had you started investing earlier instead of investing today, started 5, 10, 15, 20 years earlier, the same $60,000 investment would earn you over $9,000 in dividends today. So the advantage when it comes to dividends is the passive income grows every single year as the company increases its dividends. So let's take a look at Bell. So we're going to go back to 2012. The dividend at the time was $2.22. We divided by the share price back in 2012, which was $41.35. So you can see that the dividend yield back then, based on the purchase price, was 5.37%. Today, the company has increased the dividend every single year, and the dividend today is $3.68. So again, if we take the dividend today divided by the purchase price, which was $41.35, you can see that the dividend yield based on your purchase price, which they call it yield on cost, is 8.9%. Which is pretty good, very close to 9%. And so that's how much you would be earning today had you purchased Bell shares back in 2012. If we take a look at CIBC, we're going to go back to 2010. The dividend at the time was $1.74. The dividend today is $3.32. If we take that dividend today divided by the purchase price back in 2010, so $31.95, you can see that the dividend yield based on the purchase price in this example is now over 10%, 10.39% to be exact. So that's a really good return on your investment while you hold on to the shares. You don't need to be worried about the stock price for CIBC going up and down. As long as the dividend is coming in, as long as you own the original shares that you bought in 2010, your return today is in the double digits. It's over 10%. So that's really good. Our last example is with TC Energy. Back in 2000, the dividend was 80 cents a share. The dividend has increased every single year. Today, it's $3.60. Again, we're going to take the dividend today based on our purchase price, which was $13.40. You can see that the dividend yield is 26.87%, which is a fantastic return on your investment as you hold on to those shares. So now if we put this together on the screen, again with our three examples, with BCE, the yield on cost is 8.9%. With CIBC, yield on cost is 10.39%. TC Energy, yield on cost is 26.87%. So in our example, if you were to invest $20,000, had you invested $20,000 each in Bell Canada, in CIBC, and TC Energy, back in 2012, 2010, back in 2000, today these three companies would be generating over $9,000 in passive income for you. And like I said before, the passive income grows every year as the company increases its dividends. And these companies have a history of increasing dividends. So what does that look like over time? Just looking at these three companies alone, after 5 years from today, you would be sitting on a little over $50,000 in dividends received. Because we've also put in an average increase of 3.5 to 4.5% dividend increases, right? So that's an average. Some companies increase the dividends even more, some of them not so much. So we're making an estimation here, and we're adding 3.5 to 4.5% increase every year. After 10 years, you'd be sitting on over $113,000 in cash in dividends from these three companies. And after 15 years, that's over $192,000. So dividend investing generates passive income for you for sure, but it's generating growing passive income for you every time the dividend goes up. So that's why this is number one in terms of the 6 key benefits. And so we want to make sure we cover that first. So now let's move on to key benefit number 2, capital appreciation. So now we're going to look at 4 real life examples. We're going to look at Aflac, 3M, Procter & Gamble, and Walmart. You can see on the screen the dividend back in 2012, for all of these 4 companies. And you can see where the dividend is today. In fact, the dividends have gone up for all 4 of these companies. For Aflac, from 2012 to 2022, the dividend has gone up 138%, a little over 138%. For 3M, the dividend has gone up over 152%. Procter & Gamble, 70%, and Walmart, over 53% increase in dividends. Now, what's happened to the stock price? Because we're talking about capital appreciation here. On the screen, you can see the stock price for each of these 4 companies back in 2012, and you can see where the stock price is today for all of these 4 companies. And just looking at stock price appreciation alone, we're not including dividends now. The stock price for Aflac has gone up 180% since 2012. The stock price for 3M has gone up 77%. Stock price for Procter & Gamble has gone up 148%, and Walmart 150%. So why does this happen? How does the stock price go up? Well, what happens is when the company increases its dividend, the dividend yield goes up. And when the dividend yield goes up, it attracts investors. The stock becomes favorable, right? Like we saw in the previous couple of slides when we looked at Bell, CIBC, and TC Energy. If a company was giving you a yield of 3%, now it's giving a yield of 4%, well, now more investors are interested in it. If the yield is now 5% or 6%, more investors are interested in it because they're getting a higher return on their investment. As more investors become interested in a stock, demand for that stock goes up, and as demand goes up, the stock price goes up. So every time over the long term, when we see there's a dividend increase, we see the stock price go up. So not only are you taking advantage of the passive income that's coming to you and it's growing every year, the capital appreciation also goes up. Stock prices go up. So as dividend investors, we can take advantage of both capital appreciation and growing dividends. Number 3, now let's talk about diversification. So when it comes to dividend investing, this approach allows you to build a diversified portfolio. And why would you want to do that? What are the benefits of diversification? Well, it helps you to balance out potential volatility and it reduces your risk. You don't want to put all your eggs in one basket. So let's say you've got your entire portfolio, all of your savings in the energy sector. And let's say oil prices come down or the energy sector crashes, then all of those stocks are going to come down. And if you've got all your eggs in one basket, then your entire portfolio is going to be down. So we don't want to do this. We don't want to put all your eggs in one basket. What you want to do is over time, build a diversified portfolio across these 11 sectors you see on the screen. So we've got basic materials, communication services, cyclical consumer, defensive consumer sectors, energy, financial services, healthcare, industrials, real estate, technology, and utilities. So over time, you can't do this overnight, but over the long term, you want to make sure that you're buying dividend stocks across these 11 sectors, and that's going to minimize your risk. Now let's take a look at stability. Dividend investing is going to provide you with a certain level of stability. Companies that pay dividends tend to be financially stable and have a track record of consistent earnings. In order for them to increase the dividend, the company has to have the earnings to support it. Okay, so those companies tend to be a little bit more financially stable. And this provides you, the investor, with a measure of security and peace of mind. Over the long term, consistent earnings growth contributes to regular dividend increases. Now, there's always a risk when it comes to investing, and no one can accurately predict the future. I don't know what's going to happen next week in the stock market, next month, or next year. Is the stock market going to crash? Is it going to go up? We don't know. Are companies going to pay dividends? Are they going to reduce dividends? Are they going to grow the dividends or eliminate the dividends? We don't know. No one can accurately predict the future. So what do we do as investors, as dividend investors? So I've been doing this for over 22 years. So what we do is we look to the past to help us make decisions today. So up on the screen, you can see a list of companies that have been paying dividends for a very, very long time. Some of these companies have been paying dividends since the 1800s. You can see here, Coca-Cola has been paying a dividend since 1893. Okay, let's take a look at another one here, Black & Decker, 1876. So these companies have been paying dividends for literally more than 100 years, right? For a very long time. Now, what's even more important to us is this column right here. And you can see it up on the screen. I've highlighted it. It's the consecutive years of dividend increases. So you can see Procter & Gamble has had 65 years of consecutively increasing dividends. Coca-Cola, 59 years of consecutively increasing dividends. Johnson & Johnson, same thing, 59 years of consecutively increasing dividends. Think about how many recessions we've had in the last 59 years, how many market crashes we've had in the last 59 years. But still, companies like these have continued to grow their dividend year after year after year. So we talked about, as investors, we can't accurately predict the future. I don't know what's going to happen to the stocks that I own, to the dividends that companies are paying. Is the market going to crash? We don't know. But when we look at a list like this, we can have a high degree of confidence that companies like these will continue to pay us a dividend and hopefully increase the dividend going forward in the future. So this data gives us some certain level of confidence and stability in our dividend portfolio. Next, let's take a look at some of the tax advantages of investing in a dividend portfolio. Now, in the US, as a single retiree, you can make $50,000 a year in qualified US dividends and pay zero in federal income tax. Now, this is outside of your 401k, IRA, outside of any of those accounts. You can make up to $50,000 a year in qualified US dividends and pay zero in federal income tax. So there's a huge advantage if you live in the US for owning US stocks that pay US dividends. Now, in Canada, it's a similar situation. Now, if you look up on the screen here, we're going to look at Alberta as an example. If you live in Alberta, now every province is different. So if you live in Alberta and you are making $65,000 a year salary, you will pay a little over $16,000 a year in taxes. That's including federal and provincial income taxes. So that's a lot of money. Over $16,000 will be paid to the government, federal and provincial, in income tax. On the other hand, if you live in Alberta and you earn $65,000 a year in Canadian dividends, again, these are outside of your RRSP, outside of your TFSA, in a non-registered account. If you make $65,000 a year in Canadian eligible dividends, you will pay zero in federal and provincial taxes. So that's huge. Similar situation in British Columbia. $65,000 a year in Canadian eligible dividends, you'll pay zero in income tax, both federally and provincially. Again, outside of your RSP and TFSA, non-registered accounts. And if you've got a partner, a spouse, together, you can earn over $130,000 a year in these provinces and pay zero income tax. Now, for the rest of the provinces and territories, they're up on the screen here. You can see them all. You can pause the video if you like and find out where you live and see what you're paying in taxes. But the general theme you will see here is that in Canada, the Canadian dividends are taxed extremely favorably by the CRA. In the US, it's a similar situation. In the US, the IRS is going to tax your US dividends extremely favorably. So there is a huge advantage to investing in dividend stocks. And last key benefit is that this builds your confidence and discipline as a dividend investor. So as a dividend investor, especially when you're starting off in the beginning, you will eventually start to gain confidence as you start to see your dividend income grow each year. So start small. You don't have to invest $100,000 in stocks right away. Start small. Keep track of the dividends as they're coming in. And even during the year, throughout the year, you will see your dividend income starting to grow. And then you're going to start to build confidence. That's how I started over 22 years ago. Start small and it'll build your confidence. Also gives you a sense of stability because what we do is we focus on the dividend income and not on the stock price. Stock prices go up and down all the time. And as dividend investors, our focus and priority is not the stock price, but on the dividend income that's being generated. And we want that income to grow every year. So by focusing on the dividend, it provides a sense of stability to you. Now, a steady stream of passive income is especially important during uncertain times. So now we've got inflation is high, interest rates are going up. Dividend investors who have been doing this for 5, 10, 15, 20, 30, 40 years are doing very well even today. Because as we saw before, your passive income grows over time. It takes decades to get there, but it grows over time. So this having a steady stream of income makes it easier to get through these uncertain times. If you don't have the dividend, then you're only hoping for the stock price to go up. And hope is not going to cover your living expenses. Only dividends can do that. And then regular dividend payments, growing dividend payments help to keep you on track. So that way you're not jumping in and out of stocks. That's what a lot of new beginner investors do, is they'll buy and sell constantly. Because our focus is not on the stock price, it's on the dividends, we want to hold on to the good quality dividend stocks. And that's going to help keep you on track. So another way to build your confidence and discipline is to follow our approach, which is to invest in quality dividend stocks when they are priced low. We don't want to buy just any stock that pays a dividend. We want to make sure it's a quality stock. And we want to make sure you're buying it not at any price, only when it's priced low, when it's undervalued. So how do you know when you look at a company if it's a quality stock or if it's an undervalued stock or both? How do you know that when you look at it? Well, for that, I've created what I call the 12 rules of simply investing. A company has to pass all of these 12 rules before you invest in it. Not just 8 rules or 7 rules or 5 rules, has to pass all 12. The rules are designed to minimize your risk, keep your capital safe, and to maximize your returns. So think of this as a checklist. So before you invest in any company, make sure you go through the checklist. So for those of you on the video version, you can see the 12 rules. For those of you on the audio version, I'm going to just read out the rules very quickly here. Rule number 1, do you understand how the company is making money? Rule number 2, 20 years from now, will people still be using its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? If it's not, skip it. Move on to another company. Rule number 5, is it profitable? Rule number 6, does it grow its dividend? Right? We talked about passive income at the start of this episode. That's where rule number 6 comes into play. We want to make sure that the dividend is growing every year. Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, we want to avoid any company that has had recent dividend cuts. Rule number 10, does the company buy back its own shares? Rule number 11, is the stock priced low? If you want to figure that out, I show you in episode 1. So go back and take a look at episode 1. We talk about how to figure out when a stock is priced low and how to figure out when it's priced high. So rule number 11 is very important. Rule number 12, keep your emotions out of investing. So for those of you that are interested, I've created the Simply Investing course. It's an online video course. Takes you through all of the 12 rules, step by step. We use real life examples. I also give you a Google spreadsheet that you can use, enter in all the data. Any company anywhere in the world that you want to evaluate, put it into the Google spreadsheet. The spreadsheet's going to apply the rules. It's going to show you which companies pass the rules. So those are the ones you want to consider, and which companies fail the rules. It'll even tell you which company is overvalued and which one's undervalued. So you know what to focus on. If you want to go a little faster, I've created what I call the Simply Investing platform. It's a web app. It automatically applies the rules to over 8,000 companies in the US and Canada every single day. So the platform is a very quick way to go in there, get a list of the companies that pass all of the rules. We'll also show you companies that fail some of the rules and which one of those rules it fails. We also show you companies that are overvalued, so you can skip them. So it's all in the platform. For listeners of this podcast, take a note of our coupon code. We have a special coupon code for everyone here. SAVE10, SAVE10. This coupon code is going to save you 10% off of all of our products and services, including the course, including the platform, including our coaching calls. And the benefit with the platform is as long as you remain an active subscriber, you will receive 10% off every single month or every single year, depending on which subscription you choose. So I encourage you to take advantage of that. We've got 2 ways here, including the coaching calls, 3 different ways to help you become successful dividend investors. So the coupon code again is SAVE10. Take a look at our website for more information, simplyinvesting.com. If you enjoyed this episode, click on the subscribe button, click on the like button as well. I want to thank you for listening, watching our podcast today. We have new podcast episodes out every week, and I will see you next time.